All right, let's just cut right to the chase. This explainer is going to save you 2 solid hours of listening to the Nebius Group Q2 earnings call. We're going to dive into the exact mechanisms behind their frankly explosive growth, and I'll give you the unique insights on the hidden risks that most other investors are completely missing right now. If you follow the AI infrastructure space, you know Nebius Group, ticker symbol NBIS, has been making some massive waves. But to figure out if this is actually sustainable, we can't just stare at the headline numbers. We've got to totally tear down their business model.
So here is our roadmap for today. We're covering the AI revenue explosion, the prepayment flywheel, beating the Goliaths, squeezing AI premiums, the hidden risks, and finally, the gigawatt future. Let's get into it.
Section 1. The AI revenue explosion. Now, the word explosion honestly feels like a massive understatement here. Just look at this number, 598%. That is their year-over-year spike in annualized run rate, or ARR. By the end of June, their ARR surged to a staggering $3 billion. And hey, that's not just some weird year-over-year anomaly. It's a 56% jump just from the previous quarter. When you see top-line growth numbers like this, you really have to ask where it's all coming from. Which brings us to the next piece of the puzzle.
So their total revenue for Q2 came in at $582 million. That's up 454%. But check this out. $575 million of that, which is a whopping 98% of the total revenue, comes directly from their core Nebius AI business. This AI segment alone is growing at an insane 514% year over year. What we're witnessing is their complete transformation into a pure-play AI infrastructure powerhouse. And the profitability? It's totally following suit. They posted an adjusted EBITDA of $236 million this quarter. That is a massive turnaround from a loss last year, pushing their profit margins up to 41%. But here is the multi-billion-dollar question, right? Building AI infrastructure requires an unimaginable amount of capital. GPUs are definitely not cheap. So how on earth are they funding all of this without just suffocating under a mountain of expensive corporate debt or constantly diluting their shareholders?
That takes us to Section 2, the prepayment funding flywheel. This right here is their secret sauce. We call it the prepayment flywheel. Basically, Nebius is locking in deals where customers pay cash up front, and then Nebius uses that exact cash to buy the hardware and build the infrastructure to service those specific customers. It's brilliant. In this quarter alone, an incredible 70% of the deals they closed included these upfront cash prepayment terms. By securing this cash before they even start the build-out, they're bypassing expensive equity and debt markets entirely for a huge chunk of their CapEx.
This strategy is so incredibly effective that it's expected to bring in over $9 billion in interest-free funding this year alone. Just let that sink in for a second. $9 billion of zero-cost capital, right in the middle of an environment where borrowing money is incredibly expensive for everyone else. This flywheel is essentially the ultimate competitive advantage. It lets them scale at a breakneck pace while entirely protecting their balance sheet.
And this strategy results in an absolute fortress of a balance sheet. They're currently sitting on $8 billion in cash on hand. They opportunistically raised $2.8 billion via an at-the-market equity offering at a really healthy $224 a share. But honestly, the most fascinating detail here is that $775 million in asset-backed debt. They secured this at a very favorable mid-single-digit interest rate. How? Well, because GPUs have literally become an investable asset class. Nebius is actually using their deployed GPU infrastructure along with the cash flow from a $40 billion committed contract backlog as collateral. It's a real game changer. Oh, and by the way, if you want to stay updated on the latest US stock market news, make sure to subscribe to my channel. I upload new explainers every week.
All right, moving on to Section 3, beating the Goliaths.
So you're probably wondering, how does an independent AI cloud provider survive against the hyperscaler tech giants? You know, the Googles, the Amazons, the Microsofts. Well, the answer is they aren't just surviving, they are aggressively winning. This quarter alone, Nebius secured 4 landmark deals, each averaging over $1 billion in size. We are talking massive 1 to 3 year contracts from huge AI players like Reflection, Cohere, massive Neolabs, and even giant US quant trading funds. These are not just walk-in customers who couldn't get capacity anywhere else. No, these are highly contested premium deals that Nebius is actively stealing right out from under the established hyperscalers.
And the real reason they are winning is perfectly summed up in this quote shared by their chief revenue officer from a major client. During their proof of concept, the client literally called it the best POC they've ever experienced. The hyperscalers are massive for sure, but they can be incredibly rigid. Nebius is winning on extreme performance, rock-solid reliability, and what they call white glove support and high transparency. They are giving these billion-dollar clients a level of flexible, highly customized service that the tech giants simply can't match, especially as these clients look to build out sovereign clouds and lean heavily into open-source AI ecosystems.
Section 4. Squeezing AI premiums.
Okay, so now that they have the clients, how are they actually monetizing them? This is where the financial engineering gets really clever. Nebius operates on 3 distinct tiers. First, the long-term deals, 3+ years. These provide a stable baseline backlog. That's the $40 billion we talked about earlier, which they use to go out and get cheap bank loans. Then you have the midterm deals, 1 to 3 years, which yield about $20 to $25 million per megawatt. Crucially, the prepayments on these midterm deals cover 50 to 60% of the capital needed to actually build them. But then you have the short-term deals. These are under 6 months, aimed at clients who are just desperate for immediate compute power. For these, Nebius is charging a massive premium. We're talking a yield of $40 to $50 million per megawatt.
And they're actively weaponizing this scarcity in the market. Nvidia recently hosted the industry's first-ever capacity auction for the highly coveted Nvidia Blackwell chips. By intentionally shortening the sales window and making clients bid against each other for immediate deployment, the auction actually cleared 15% higher than their previous peak pricing. They are purposefully keeping a portion of their capacity purely for these short-term, ultra-high-margin deals just to absolutely maximize their cash generation.
Which brings us to Section 5, the hidden risks.
Look, it's not all sunshine and zero-cost capital, right? We have to stress test this model. First off, there is a pretty significant margin drag. The core Nebius AI business is a total cash machine, operating at a phenomenal 50% EBITDA margin. But when you look at the total group adjusted EBITDA, that margin drops down to 41%. That 9% profit leak, it's pretty significant. It comes from Nebius pumping heavy early-stage investments into their other ventures, specifically Avride, which is their autonomous driving unit, and 1010, their edtech business. Now, if these secondary ventures start burning through cash faster than expected, or if they fail to commercialize, they're going to continue to act as a heavy anchor dragging down the overall group's profitability.
The second major risk here is purely logistical. I like to call this the connected to revenue time gap. Nebius talks a whole lot about hitting 1 gigawatt of connected power by the end of 2026. But as their head of infrastructure pointed out, hitting a power target doesn't instantly equal cash flow. Once the facility is totally finished and the power is connected, you still have to build the complex networking, assemble the GPU clusters, deploy the cloud platform, and then fully onboard the client. Any little hiccup in the supply chain or technical integration can easily delay revenue recognition by months.
And that leads us to the biggest stress test question of the whole explainer. To support this insane growth trajectory, Nebius is forecasting a capital expenditure mountain of $20 to $25 billion for 2026. Yes, they have the prepayment flywheel and the asset-backed debt working right now, but what happens if the macroeconomic credit markets just suddenly freeze up? Or what if a couple of those billion-dollar clients face unexpected headwinds and delay their prepayments? The sheer scale of this gigawatt-level expansion means Nebius is entirely dependent on rapid, flawless capital turnover.
Section 6. The Gigawatt Future.
Assuming they can successfully navigate those risks, the horizon here is incredibly ambitious. Based on surging demand, Nebius just raised their 2026 contracted power target to an unbelievable 5 gigawatts. And starting in 2027, they're planning to add over 1 gigawatt of new capacity every single year. A really fascinating detail about their execution is happening at their Vineland, New Jersey site. To avoid local grid delays, they're just completely bypassing traditional power infrastructure and deploying Bloom Energy fuel cells right on site to ensure they hit their targets on time. Plus, by late 2027, they'll transition more towards owning their own data centers, which management strongly expects will trigger a major boost in gross margins. And to top it all off, they are already validated and getting ready to deploy Nvidia's next-gen Vera Rubin chips by early next year.
Ultimately, the scale of what Nebius is attempting is historic. They are acting as a true, independent counterweight to the tech giants. But it all comes down to execution. So my question to you, based on today's report, is this. Do you think Nebius's operational execution can actually keep pace with their extreme $25 billion capital demands? Or will the massive weight of that capex eventually catch up to them? Let me know your thoughts down in the comments. And for my second question, which U.S. stock or company would you like to learn about in our next explainer? Drop your request below. Thanks so much for joining, and I'll catch you in the next one.